Welcome to The Explainer. Today we're jumping right in and putting Suncor Energy through the absolute ringer. We aren't just skimming a standard earnings report here. We're taking the legendary investment frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, stacking them alongside strict cash flow modeling, and applying the whole shebang directly to Canada's leading integrated energy company. As an analyst, I absolutely love doing this because it strips away all the daily market noise and forces us to look at the cold, hard numbers through proven historical lenses.
Here is our roadmap for The Explainer. 1. Company snapshot. 2. The Warren Buffett lens. 3. The Peter Lynch lens. 4. The Benjamin Graham lens. 5. Cash flow valuation models. And 6. Our synthesis and final verdict. Let's dive in. Section 1. Company snapshot. Suncor Energy.
All right, let's set the stage. What exactly is Suncor bringing to the table right now? Trading around $87.50 Canadian, which is roughly $62.43 US. Suncor, ticker symbol SU, is an absolute behemoth in the space. In the first quarter of 2026, they posted record production of over 875,000 barrels a day. But honestly, what really matters for our analysis is the cash. They generated a staggering $2.9 billion in free funds flow in just 3 months, alongside $2.3 billion in adjusted operating profit. They've got this massive asset base spanning oil sands mining, offshore production, and petroleum refining. The business is literally printing money right now, but we have to ask, does that actually make the stock a buy?
Section 2. The Warren Buffett lens.
So, would the Oracle of Omaha actually buy Suncor at current prices? We know Buffett is hunting for a moat, consistent earnings, manageable debt, and honest management. And you know what? Suncor actually passes most of this incredibly strict checklist. They have a fantastic economic moat with a massive integrated supply chain and a 25-year reserve life. Their return on capital employed sits at a very healthy 12.4%. Debt? They're incredibly well positioned there. Their net debt is $6.8 billion, which is only 0.5 times their adjusted funds from operations. That is highly manageable. And as for honest, shareholder-friendly management, well, they returned over $1.5 billion in value in Q1 alone, split between $825 million in buybacks and $712 million in dividends. Really, the only borderline criteria here is earnings consistency, and that's simply because oil is such a highly cyclical commodity. Though to be fair, their annualized free funds flow sits at a monstrous $11.6 billion, proxy for owner earnings. But here's the catch. Price is everything for Buffett. Based on those massive annualized owner earnings of nearly $11.6 billion, Suncor generates tremendous cash for sure. However, Buffett famously demands a strict margin of safety, especially to account for the inherent commodity risk of oil prices. Because of this, his buy trigger would likely demand a much steeper discount from today's levels. We're talking a Buffett-style buy price closer to the $75 Canadian mark.
Section 3. The Peter Lynch lens. Now, if we look through the eyes of growth at a reasonable price legend Peter Lynch, he'd undoubtedly categorize Suncor as a cyclical stalwart. It's a massive, slow-moving beast whose fortunes really ebb and flow with the broader macro environment. Looking at the raw numbers, Suncor has a trailing 12-month EPS of $4.85, giving it a trailing PDE ratio of roughly 18 times at the current price. They're projecting an additional $2 billion in free funds flow growth by 2028. Now, that implies a moderate PEG ratio of around 1.5, which suggests the stock is fairly valued. It's not a screaming bargain, but it's not wildly overpriced either. Lynch would also highly praise their balance sheet, boasting a very comfortable $9 billion in liquidity.
But what really catches the eye here and what cements a Lynch, hold, or even a cautious buy rating is this cash return projection. Suncor is forecasting between $23 and $33 billion in cumulative cash returns to shareholders over the next 3 years, strictly depending on where WTI crude prices land. If you're an institutional investor, that kind of ratable, reliable cash return is practically impossible to ignore, and it aligns perfectly with Lynch's love for companies that reward shareholders while maintaining extreme financial resilience. Section 4. The Benjamin Graham lens. Okay, let's really stress test this thing using the grandfather of value investing, Benjamin Graham. Graham's defensive checklist is famously brutal. Suncor easily passes on adequate size. They pass on strong financial condition since their liquidity easily exceeds their net debt. They absolutely pass on dividend record, paying 60 cents a quarter continuously. But here is where they hit a massive wall. Graham demands a moderate price-to-earnings ratio strictly below 15. Suncor sits at 18. He also demands a price-to-book ratio below 1.5. With a book value per share of roughly $38.66, Suncor's price-to-book is around 2.26. That is a hard fail on Graham's valuation multiples. To nail down an exact number, we can use Graham's famous intrinsic value formula. It's essentially the square root of 22.5 multiplied by the trailing EPS multiplied by the book value per share. We just plug in Suncor's trailing 12-month EPS of $4.85 and their book value per share of $38.66.
Let's actually do that math. 22.5 times 4.85 times 38.66 equals about 4,218. Take the square root of that whole thing, and you get a Graham intrinsic value of exactly 64.95 Canadian. Meaning, at the current price of $87.50, Benjamin Graham would look at this, declare a complete lack of a margin of safety, and rate this stock a definitive sell or avoid.
Section 5. Cash flow valuation models.
All right, let's put the qualitative guru stuff aside for a minute and dive into the hardcore quantitative math. To build a realistic discounted cash flow model, we need to make some very specific assumptions. First, we forecast free funds flow conservatively at a baseline of $7.3 billion annually. That aligns perfectly with management's guidance, assuming a modest $65 WTI oil price. Second, we apply a 10% weighted average cost of capital, which is pretty standard for energy majors facing market volatility. Third, for the terminal value, we're assuming a 0% perpetual growth rate. Why? Well, long-term energy transition risks make it a bit imprudent to assume infinite growth for fossil fuels. And finally, we subtract their $6.8 billion in net debt to find the true equity value.
When we run those assumptions through a sensitivity table, it's pretty eye-opening. At our base case 10% WACC and 0% terminal growth, Suncor's fair value sits around $66.50 CAD. In fact, to mathematically justify the current $87.50 share price in a DCF, you would either need to drop the discount rate below 8% or assume perpetual positive growth, which essentially means betting that oil will stay permanently elevated near $80 a barrel. So, based on conservative DCF metrics, it appears quite overvalued.
Section 6. Other valuation models.
Let's cross-reference that DCF with two other standard valuation models, just to make sure we aren't missing a hidden angle. First up, the dividend discount model, or DDM. If we take their current $2.40 annualized dividend, assume a generous 5% perpetual dividend growth rate, and a 10% cost of equity, the DDM yields a heavily discounted fair value of just $48.00 CAD. On the flip side, running a reverse DCF tells a fascinating story. To mathematically justify today's $87.50 CAD price tag, the market is already pricing in a highly optimistic reality where Suncor generates roughly $9.5 billion in free cash flow every single year, forever.
Section 7. Synthesis and final verdict.
So, we've put Suncor through the absolute ringer today. Looking at this master scorecard, the primary strength of this investment is undeniably their world-class operations and record cash returns. But the glaring risk? Valuation. Warren Buffett would likely hold and wait for a drop to $75. Peter Lynch might hold for the yield, but definitely wouldn't call it cheap. Benjamin Graham's strict math says sell at $64.95. Our base case DCF says sell at $66.50. And the reverse DCF shows the stock is priced for absolute perfection, requiring $80 plus oil in perpetuity. Therefore, when we blend these insights, virtually every rigorous valuation framework suggests the stock is fully priced, if not overvalued, at $87.50 CAD. Ultimately, Suncor as a business is fundamentally stronger than it has ever been. They've slashed break-even costs, they've increased capacity, and they are treating shareholders exceptionally well. But as analysts, the math just doesn't lie. So you have to ask yourself, is their massive execution and juicy yield worth paying full retail price today, effectively abandoning your strict margin of safety? It's an absolutely fascinating trade-off between operational excellence and intrinsic value. Thanks for joining me on this explainer, and I highly encourage you to run these exact frameworks on the other stocks in your own portfolio.